All right, let's talk treasuries here as we head into the bell. Bonds at the lows of the day. Collin Martin joins us, Director and Fixed Income Strategist at Schwab's Center for Financial Research. Collin, good to see you, sir. What's going on?
Good to see you, Oliver. Thanks for having me.
Hey, am I going to see you at Impact?
I'll be there. Yeah.
Boom.
I'll make sure I find you.
All right, let's go. November. I just booked it today. Hopefully we'll see some of our viewers there. So, Collin, this yield move is like kind of unrelenting. What's going on?
Yeah, it really is. Even today, it looked like we got a little bit of a reprieve where we saw yields come down. And then as the day progressed, especially following after the stronger than expected sentiment report, we saw yields continue to rise pretty much all across the curve. And that 10 years kind of testing that 4.25% high that we're at since the end of July, really. When we looked at this week specifically, there really wasn't much of a catalyst. If you look at the broad economic data, it was pretty mixed. You saw some good, some bad. If you looked at that beige book that we got in the middle of the week, it was relatively muted, but I could say tilted towards the downside where a lot of districts weren't showing much growth. But then we got that strong sentiment report today with lower inflation expectations. And that's more in line with what we've seen over the past few months. We look back the past 6 weeks or so, it's really been this positive surprise, positive momentum that's driven yields higher. And even though it was a slow week this week, we saw yields continue to trend higher kind of on the heels of that. I think next week is going to be very important because it's chock full of economic releases.
If stocks get earnings going the wrong way, does that have the ability to interfere with the message of the bond market, Collin, or how do you view that relationship? Because this week, stocks sold off pretty hard and bonds sold off throughout it when we had our one decent tech dip Wednesday, right? And bonds sold through that. So does that catch our attention?
Maybe a little bit. Over the past few years, that relationship that, has generally held for decades of, from the diversification benefits of holding stocks and bonds, it broke down a couple of years ago. And then, as you alluded to, we've seen it a little bit this week with stocks down, but long-term yields moving a little bit higher. I think that could continue. I think that the key driver right now are kind of the big picture economic releases, at least for the treasury market. So while there might be earnings related moves that impact the stock market, if we see economic growth, which is not necessarily always going to tie into what we're seeing with S&P 500 earnings, if we're seeing growth remain strong, if we're seeing consumption remain strong, if we're seeing wage gains increase, and if we're seeing that unemployment rate kind of stay where it is or trickle down, I think that's probably going to matter more than what we're seeing on the stock earnings front.
Okay, so it's going to be a pretty pure economic read, which should be helpful. Anything crucial or compelling you find in the curve dynamics, Collin? Any strong feelings on what type or which direction?
Well, I wouldn't say on direction because I think we can kind of stay range bound for a little bit right here. A lot of it hinges on what the Fed does or doesn't do over the next handful of quarters. We still expect them to cut rates, but the big question is how much do they cut, given that inflation appears to be a little bit sticky and the economy remains strong. One thing we're looking at, though, is looking at that intermediate part of the curve. If we go back about 2 months or so, we saw a really steep drop in treasury yields, and we've been talking about extending duration for a long time. And when we saw the 10-year yield getting at 3.75% range or so, that risk reward balance didn't make as much sense. We've since seen yields move up sustainably. We're seeing the 10-year yield up, I think, 60 basis points or so in 6 weeks. That's presented an opportunity for investors to maybe lock in that yield that maybe they thought they missed out on just 6 or 8 weeks ago. Now there's risks out there, of course. I mean, especially if growth remains as strong as it has been, maybe yields drift a little bit higher. But we think this has presented an opportunity for investors, especially if they have a long-term investing horizon.
I think that's a good point. And for those that do speculate in bonds too, the positioning got real one-sided around the Fed. So you'd think at some point there might be some kind of pushback as people probably got squeezed. It kind of burned a little bit. So some kind of riding of the ship, perhaps. I like the thoughts. Thank you very much, Collin. Appreciate it.